Today's episode of Market Talk is brought to you by GrowMark FS. Keeping up on the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic, grain, and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. Well, as we take a look at the market, trade positive money flow was seen in grains on Wednesday. Moderate gains seen throughout corn, soybeans, and wheat. Livestock were a little bit lower. We saw crude oil up around 2%. The stock market was up a little bit as well on the day. Overall, just again, a fairly okay day. One day ahead of the January USDA reports, the WASDE, and the quarterly grain stocks. Here to walk us through what he's seeing in the markets right now, our good friend Mike Zuzolo, Global Commodity Analytics, is with us. And Mike, good to have you with us once again this week, sir. I hope you're doing well, and hopefully you are as ready as I am for USDA's big data dump on Thursday.
I always pick out a good movie and a good book before a USDA report. I think I'm going to have to do at least 2 movies and maybe a full book, because I just don't think I'm going to sleep this next 24 hours here, Jesse, until we see these numbers, because so much is at stake right now with the markets.
Very true. Well, and typically this January set of reports is the biggest report of the year, traditionally anyway. And it seems like it's going to be that way this year. There's so much at stake here, as you said, Mike. As we take a look, just in general, looking at the markets, the grain action first on Wednesday and how that correlates in. I know there's a lot of factors in the backdrop here, South American weather, etc. What are your thoughts here? Let's just jump right into this. What are your feelings here ahead of this report?
Yeah, I felt like that the wheat market finally felt a little bit more of the sensitivity with the outside markets. And that's really crucial with these USDA numbers, because what I drew up for you and the viewers today, Jesse, was the copper market against the soft red wheat futures. And then the red line below, maybe the most important of the 3 lines, is the 20-week correlation, the price relationship between those 2 lead month futures. And we've gone from almost 80 to 90% positive as of July, August, September of last year, to about 76% negative in price action on a weekly basis, on a 20-week basis. And the only time I can find that we've done this type of price action where one goes one direction and the other goes another direction is back in early 2019. But even there, that only lasted for about 60 days, and it was nothing close to what we're experiencing right now, where the copper is following the crude oil, which is following the Asian market strength, kind of surprising Asian market strength, if you will, and a continued weaker dollar, stronger Chinese currency, and strengthening Brazilian currency at the end of Wednesday's trade. All of a sudden, we're seeing this copper move back up to levels not seen since June of last year, while the wheat just continues to be flushed and rallies are sold, soft red being led down by the hard red. So this is a key issue for me, and has been. I'm hoping that this comes in and supports, these macro factors comes in and supports this market all the way through USDA's numbers tomorrow.
Well, before we get to the number estimates that you have, I know another issue that we're watching in this trade overall, South American weather. I'm going to pull up, this is a map on the video screen you provided for us as well, looking at that precipitation forecast, Argentina, Brazil. I know there's been a lot of dryness at Argentina, a lot of concern, a lot of thought in the trade that USDA will start making cuts to Argentina production on Thursday's report. Brazil's still looking fairly good, though. What's your thoughts with the South American weather situation and how that's tying in?
My thoughts are very simple based upon this 3-day model map and precip forecast. And where the blue dot is Rio Grande do Sul, and that's one of the driest, one of the largest areas of southern Brazil in terms of production, and one of the driest this year, and could bring down overall production if they don't get necessary rains. But when you look from west to east on this map, Cordoba, Santa Fe, and then the blue dot of Rio Grande do Sul, Santa Maria, I believe is what that is. You see a real shift. These are the driest areas of the last 5 months. Now all of a sudden we're seeing those southern Brazil rains start to sneak deeper into southern Brazil and into northern Argentina. This really puts pressure on the soy complex for the USDA numbers to support the soybean rally that we've seen since last month, and the fact that the meal market is only about $20 a ton from checking a 12-year high. That 521 level that we got up to several months ago, that was an 11-year high. So if we take that level out and get into that 525 area in front end meal, you'd be talking about a 12-year high in that meal market. So I think you're really at a point, and this is probably the most concerning feature to the USDA report for me tomorrow, is feeding the bull in the soybean complex, because we may lose 500,000 to 1 million metric tons in Argentina, but we may just gain that right back plus some more in Brazil, just based upon what USDA may look at on their crop satellite data. So net for me, Jesse, I need to stay below a 102 million metric ton ending stocks number for the world soybeans. If we go 103 plus, I don't think it justifies $15 soybeans.
Well, let's look at some of the estimates here, and this is a look at the various estimates we'll have for tomorrow's report. Any thoughts with what you're seeing with some of those pre-report estimates, Mike?
Yeah, covered the world ending stocks for soybeans, and so I am above 103, and that would concern me if I'd actually see that. The opposite of that would be the U.S. wheat supplies. We came in at 571 last month, Jesse. My modeling data would suggest at a 571 carryover, soft red wheat should be closer to $9.80 to $10 a bushel in the futures market. And yet we see the DTN cash index for soft red wheat all the way down at $7. And the futures market just got done checking $7.20 this week in soft red. Even the USDA is above $9 in their average price. And so taking the highs that we made and the recent lows that we made, we should be done going down if we only have a 571 or lower carryover on tomorrow's report. What I think this market has done in the last 30 days, especially in the hard red, it's reflected in the wheat market, the European futures, the world supply demand, and declining demand. It's not reflected the U.S. supply and demand. So I'm hoping between the U.S. supply demand numbers, the winter wheat seedings numbers, and then coming in at like a 268, 269 world wheat ending stocks number, we see a lot more reason for the wheat to find some short covering. And that's where, again, those macro markets seem like they're trying to support us here.
Well, and thinking of those macro markets and energies as well, you also brought me the weekly WTI crude oil continuation chart, and I'll pull that up on the video. And we've talked before about this crude oil market and how it's playing itself into the commodity trade, kind of a canary in the coal mine type here. What's the latest you're seeing with crude oil? Because to me, it still keeps hovering in this $70 to $80 range and just can't move one way or another out of this range right now, Mike.
That's an excellent point. And we're probably going to look at this each week, because I did show you this last week. We had that big down week last week, that last red bar where we made a new 3-week low, and we were going after that $70 level, it looked like. But then all of a sudden, the Asian markets turned higher, Hong Kong equities, Chinese currency, and then the dollar fell, and all of a sudden the crude oil lit up, and now we're starting to see a real turn in the crude oil. But if you look at this weekly chart, it's an inside week, which means we've not taken out the weekly high nor the weekly low from last week. So we're not doing anything technically good or bad, and we still haven't broken above that channel, that purple downtrending channel. That's what we need to break back up above in that resistance level. And so a weekly close this week at $80 or higher, I think would probably pull the dollar into a level below its long-term support. And all of a sudden you'd probably find the mindset in the trade that, wait, look at this. We've got Asia back. We've got China back. Let's start buying commodities again. So you're exactly right. The crude oil is our best canary in the coal mine right now.
It feels like to me as well, with all these different factors playing in, we're kind of on this seesaw. We're on the edge of maybe a small cliff, so to speak. I'm not going to call it a big cliff, but it's like we're teetering one way or another. And if too many things go one way, we're going to go down, or too many things go one way, we're going to go up. That's the feeling I have going into this report right now, Mike.
I think you're right on, and I think the charts show that. We've talked about those commodity index charts and the wedges, the triangles that are forming. There are probably a dozen charts out there that I could pull up right now, Jesse, that are forming that same type of triangle based upon multi-month highs and multi-month lows. These are big wedges. These are big triangles on some of these weekly and monthly charts. So I think you're right on the money with feeling that something's going to give one way or the other. I think if you take a step back and you think about that crude oil chart and you think about going above $80 a barrel, if we would do that this week, at the end of this week, that would be upon the World Bank giving us a new world economic outlook for this current year of only plus 1.7 for the whole world, less than 2% growth. That's almost half of where it was back in June when it came out with a 2023 estimate for world growth. And so I really feel as though that if we can go above $80 in crude with that kind of information, the trade will have chosen the idea that China is going to recover faster and COVID will not sink the global economy, won't sink the global commodity demand like we're seeing reflected in the hard red wheat especially.
Mike Zuzolo, Global Commodity Analytics, is our guest analyst here today on Market Talk. And Mike, another thought here, just in this grain trade overall, heading into a big report day. Is there any thoughts you would have, anything just in general for producers to maybe protect some risk here? Should they be looking at doing some of that, some short-dated options, different things? I know there's a lot of tools in the toolbox. Is there anything they should be thinking about here heading into this report?
Yeah, I think so. I mean, the big thing I'm watching is going to be the soybeans, as I talked about, Jesse, not just because of where they've got a premium in them from the weather market, but also you look at $15 cash. I think that's where the DTN cash index is right now in beans. If you did 60 bushel yields last year, you're talking about $850, almost $900 of acre revenue. And I think you have a market structure with the meal inverted and premium in the January, which is getting ready to go off the board in a day, and a July Nove bean spread that's still pushing about $1 premium in the July. If the USDA comes out with a bearish, a price negative report tomorrow, I would think you'd see those spreads start to collapse. So I think you could go after some short dated options like a March soybean put, like a $15 put or a 1460 put, and that would be, I think, almost as good a protection as going out into the new crop, just because of the structure of this market right now. So that's what I'm going to be talking with clients about tomorrow after I see these numbers, if I indeed do get that 103 ending stocks number in the world, and I see Cordoba and Santa Fe, Argentina, getting some rains.
All right, Mike, let's flip over to livestock. The positive money flow wasn't in livestock on Wednesday compared to what we saw in grains. Wasn't a terrible day, but was it a great day? It felt like at cattle and hogs. Just your thoughts in general in livestock. I know we have another chart to look at as well, but overall, just to kind of set us up here, what was your general feeling of Wednesday's trade action in the protein sector?
I think the futures market has done a good job of anticipating, I should say, the excitement in the cash markets. And now it's waiting for some cash news. And we can't get that much cash news yet coming back from the holiday. And it's still pretty opaque what kind of a holiday trade we had, Jesse. So I think the futures traders and the funds feel like they are long enough. And I think that's especially the case when they see that the pork cutout has hit levels down to December of 2021 levels now in the pork cutout this week. And we started to see the futures fall to the cash index at the CME. And we started to see the February hogs fill a gap on Wednesday's trade at around 79.10, 79.15 in the February daily hog chart. So now all of a sudden you've got the fat cattle at almost $80 premium to the hogs. You're waiting for that next weekly export sales. You're waiting for the WASDE numbers to give us fresh export data when it comes to 23, as well as fresh production data. So I feel like the market is, the cattle market in particular, I think, is waiting for hogs or feeders to make a move. The feeder market is the big question mark. I think hogs are nearing their bottom at this point. I think we're going to start seeing a lot better demand at the retail level for the pork, especially against chicken. But I think the feeder cattle market is the one that really makes me wonder, because we're still in the middle of winter, and yet we also have a lot of excitement already built into this market.
Well, you set up the segue perfectly. I want to talk more about that feeder cattle market. You sent me over a chart here for the video feed, and I know just a general demand in this feeder cattle market has been fairly robust as of late. As you look at this chart, though, walk me through what you're seeing here and talk a little bit more just about your feelings in this feeder cattle market right now.
Yeah, the big thing that I see in this chart is that purple wedge, that triangle that we were just talking about. Another chart where you've got a major wedge being formed, and you're coming right to the point. So, like you said just a minute ago, it feels like something's going to have to give in these markets. And so, the very next thing I look at then are those highs back from 2014, 2015 that everybody seems to be talking about in the cattle markets right now. I can't see us getting to those price levels without a terrific winter storm and a real hit to the supply side. Why is that? Because back during that 14-15 price rally of 220 to 245 feeders, we had cattle rolling, we had hogs at 130, and we had corn at 365. And so this week, I think, has supported my analysis that feeders are still attached to the hip of the corn market, and we started to see the feeders go negative on the week today, and this monthly chart's now negative on the month of January, mainly because that corn market was able to bounce. So if we would break that wedge, that triangle, and take out last month's low of 180-ish, that's the very next black bar there, right closest to the price. If we take 180 out, you can see where we'd lose some support, and then that orange trend line comes in around 170. So it would not shock me if we got a bullish report on corn from the USDA to see a quick $10 dip in the feeder cattle market. And I do think that would probably put the kibosh on a future rally in the fat cattle. And I'd probably start looking at hedges for especially the April cattle, given where they're at in price.
Well, and I'm glad you brought up, maybe a bullish report in corn and how that would play into feeder cattle here, Mike, because I wonder what could we see with some of those feed numbers from USDA. I'm just curious what all that could look like on the report on Thursday, if we see any big surprises there. I've heard a few other folks mention to me they might be looking at some of those feed numbers for surprises in Thursday's report.
Yeah, that's a really good point. I'm going to compare the feed number against the ethanol, and I think that's going to be the net between those two. We know the exports are probably going to be down pretty good because we just can't get those exports back from Brazil that they've shipped to China. So that's a real big point. I think that's an excellent point you make, is the line items and the grain stocks as well. Who's holding the grain stocks for the corn when it comes to tomorrow's report? Is it going to be the commercial or is it going to be the farmer? I've seen a lot of trucks and heard a lot of trucks moving this past week. So I think the on-farm storage number is going to be lower than what we see tomorrow. It's going to be the commercial number that I really look at especially.
Yeah, I've heard the same. A lot of farmers selling here the last couple of days. It's amazing that calendar flips to a new year, Mike, and then all of a sudden those bin doors open up if we got good weather. I mean, it's not unexpected, I should say, this time of year.
We're not acting like we made near record profits this past year. It seems like we're wringing our hands, and it's because we have so much uncertainty to look forward to. But one in the hand is worth two, or one in the bush is worth two, or whatever the saying is. One in the bush is worth two in the hand, or whatever. It's go after the profit.
Yes, go after the profit. And that's part of why we talk on this show, to try and help folks and explain these things to them. And every now and then we throw some humor in. I got Mike to crack a little bit today.
And I flunked college poetry, and I'm proud of it.
Mike, before I let you go, I'll open the floor to you here. One final question. Any final thoughts you want to share with us here ahead of the reports on Thursday? Anything else top of mind for you, or anything you want to reiterate here today?
Yeah, I'll clean up my last point that I was trying to make. I really think it's important that we don't get caught up in what could happen. We look at these numbers, we look at the charts at face value, and we make some simple decisions. Is this good money or not? And is there more downside since the numbers came out or not? And just leave it at that. And I think that's what I'm going to really strive to do with all the clients and subscribers I work with.
Well, if folks want to work with you, Mike, I know they can reach out, and there's a lot of great resources you have. What's the best way to get in touch with you?
Best way is go to GlobalCom Research. It's globalcom with 2M's research.com. Having said that, I've had a lot of phone calls on the toll-free line here in the last month, asking specific questions, wanting to have a visit. So call me at 866-471-2588. Be happy to have you here at the office or come out and meet you at your operation.
Well, again, that website too, GlobalCom with 2M's, globalcomresearch.com. And with that, Mike Zuzolo, always a pleasure, sir. Thanks for joining us this week, and we will talk to you again next week.
Thank you, Jesse.
That's going to do it for Market Talk today. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.